Hi all, welcome to Free Float. I'm and have Kishan with me.
Hi. Welcome.
Today we are doing something new. We have a book review for you. It's a book that everybody has been going gaga over in Finwit. So Kishan has done a deep dive into the book, and he's going to share with us why it is relevant, and what are the key takeaways from it. So
Yeah.
Kishan, take it away.
Yeah. So Sham, have you read the book?
No, I'm going to read your cliff notes and say and tell everyone that I've read the book. So I was
Right.
waiting for you.
Okay. Fine.
I was waiting for you to go first.
All right. Okay. So so I read the book because I mean, not because I was looking to read something. I mean, like basic finance, um, but because I like like Morgan House's blog. The first blog that he wrote, which I thought was extremely interesting and like well written. Like very easily written, but convey something very profound. Or something very deep. So when I read the book, I mean, the book is nothing, that you'll find, like like extraordinary, or I mean, the idea is simple. Most things we know, even somebody who has a very simple understanding of finance or like investing, will know, will know these things from an from an intuitive, perspective. Um, but I thought, what we like always try to convey, through our videos and through Free Float and stuff is, it's not what stock you buy, or what, uh, or it's not about finding the multi baggers and then, making a lot of money from that, but rather it is, it is to, it's taken to a plan, which is the first video that we did, which is that most people fail when they plan, the way they made a plan does not work, and and most times it doesn't work because people have either a short-term horizon, or like the expectations are a lot, and they forget that the I mean the idea of investing is to is to uh, is to build wealth, you know, but building wealth takes time, Also for you, the idea is to generate a like an additional source of income. Then even that, you would need to know what what you're investing for, and then just stick to it without getting distracted. Like like I think Warren Buffett quoted this, that nothing gets somebody more like upset than seeing his neighbor get richer, right? And and like, especially because if someone makes money out of a stock, everyone tends to brag about it. No one talks about the maybe like 90 investments that's gone bad, but if one makes it, then everyone talks about it, like it's the greatest thing ever. And that
That's my pet crib about talking about your portfolio in general, because that one stock that became a multi-bagger, it may not make an iota of difference to you if you've allocated only, say $1,000 to it, right? So so you kind of take a portfolio approach, and that portfolio includes everything, right? Your entire wealth, because capital allocation, it's a decision made on 100% of your wealth. How much are you putting in your savings account, how much are you putting in your debt fund, how much are you putting in real estate, your own house, and then stocks. And you have to sort of take that holistic approach and track that, to figure out whether you made the right investment decisions or not. That one single stock is not going to help you in any way, and this has been my pet crib all along, because even serious professional investors make this difference. They have a strategy which goes stocks versus bonds, and they often say, oh, now I'm all in cash, and my IRR is 110%. But that's some BS, because when you're in cash, you're earning nothing, right?
Yeah.
So you have to take that entire you have to take your cash allocation into your returns calculations as well, and then that 100% or 110% IRR suddenly becomes 10%, because your cash didn't make you that much money. So I'm with Morgan on this one. He's been beating the drum on why this overall allocation is way more important than that single stock
Yeah.
that everybody brags about.
Yeah. And I think, I mean, the entire point of the book is, it's a few things, right? To do, things which are, conservative in terms of finance, in like, not doing something too fancy, sticking to, to what you know. Uh, Three is, like having a long investment horizon, because, we know that, uh, markets can go, like, up and down, like, like this has gone up and down. But it's very hard to predict what a market will do in the short run. Uh, but the idea is that, if you have a long investment horizon, uh, uh, you would you would have better luck, in in creating some wealth for you. And that's a trick that most people forget. That it's very hard for you to make your investments, um like double or triple in say 2 or 3 years. That's really impossible. I mean, you can get lucky by getting the timing right at one point, but it's not something that will happen continuously. So it's very, you know, wrong for someone to think this. That I mean, and the other thing which he talks about a lot is he like has this brilliant line about how saving is the difference between your income and your ego. So so the thing is that in an extra bit of saving can add like multiple. I mean, can add those extra. I mean, can add those extra percentage points. I mean, to your investment return, which you were seeking, and you're trying to do all kinds of like aerobics to generate it. But those extra points will compound and will become a much bigger sum in the future. I think that's something that I think if you read Warren Buffett, or or even if you read your grandparents talk about, it's something that is something which is very familiar. Uh,
Yeah, but see, a lot of this, these books, they have a very US centric approach.
right.
Um, I posted a bunch of charts, I think yesterday or something, that showed the inflation adjusted returns,
Right.
right, of Indian equities and bonds over the last 10 years. One simple way to do inflation adjustment, if you um, don't have access to CPI data, is like a close proxy is to convert it to dollars. Like
Yeah.
look at dollar returns, because
Right.
it over like a 10-year period, it evens out.
The
So
parity. Yeah.
yeah, so what it showed was Indian bond investors made zero returns over the last 10 years,
Yes.
and Indian large cap investors made about 2% uh, returns. So that 2% is actually um, inflation adjusted. So it is at least not negative. That's how I would put it. But it also nothing compared to what the S&P 500 return over the same period. Now, it is very easy to fool yourself as a US investor, as a like consider yourself as a great investment guru or great investor, because the US is different, right? US equity markets are different, and at least after the global financial crisis, it's been ripping higher and higher, like there is no tomorrow.
Correct.
And during this bull market, you can fool yourself, in multiple ways. So I would take all these preachings with a grain of salt, and say, the reason why you make money is at the end of the day, you want to spend it on things that you care about. So, all this nonsense about let's skip a latte and put that in the piggy bank and look at compounding. It works, number one, if that latte makes a huge difference
Different.
to your,
Yeah.
yeah, to how much you save. Most of the time that you know
It will be spent somewhere else.
yeah, because see, the worst thing you can do is is to be in a miserable state of mind because you
Right.
tie yourself
And
in
then
knots.
and you'll be more likely to get frustrated at some point.
Yeah, and you'll
Yeah,
spend it
no,
on
I
somewhere else.
think I think I think the overall point here is not to save latte and the everyday instead of putting in latte, putting in piggyback, but it's like more broader, like the idea to just to have just to save so that you can invest. I mean that's a more broader thing than instead of say saving skipping like you can skip the barber and skip your latte and skip all this and then be live like Uncle Scrooge, and then you can I don't think I don't think that's the idea. I think the idea is more to the idea is more to do with we want to build a I mean like a portfolio or build a investment portfolio, but but if you just save probably 2% of what you're seeing from an investment point of view, that's also like adding to your like to your uh, to your portfolio, which will compound, and that makes a difference. That if you and it's maybe it's prudent, maybe it's uh, uh, maybe it's thinking in a different way, but those things always add up. Yeah,
Yeah, I mean, I agree that it adds up. I'm just saying you have to be a bit pragmatic and not
of
get too
course,
caught up with
of
that.
course, of course. I get that. The other thing, I mean, the book is mostly stuff that we would know pretty well. That the idea. I mean, for most people, I think if you ask most people what they need money for is to be financially independent, or to do what you want, or to do wish to, or I mean, to be able to do what you wish, And I think the book makes a good point about about emphasizing that, like I mean. The, the, I mean, the utility of money comes from, or of gain of money comes from, the independence that it could provide someone. So if you have a plan that in the next 10-15 years I want to do something that that I mean I would want to wake up and do what I want. If you have a plan and if you invest based on that plan, you are more likely to succeed. And I think many people are out there seek that independence.
Right, I agree.
And I think that I mean that also would again comes back to the thing that you you cannot get there from betting on one stock, like betting your entire portfolio on one stock. It would come from for you from providing an investment plan and and following it and executing it, and which is what we try to convey, that like uh, like most people, I think, when the market, falls and stuff, they would panic. But, the idea is that, if you just stick around, I mean, over the long run, um, um, things would even out,
Right. So my approach with with investors is to sort of paint them a picture of what failure might look like upfront.
Yeah.
right? So the biggest point of failure, like you said, what happens when the market tanks 20%, right?
Yeah.
So the first thing you need to do is, how is your portfolio going to get affected when the market falls 20%? Um, so most of the time, you can't optimize a portfolio that prevents steep losses and gives you unlimited upside, and does a whole bunch of other things, and is easy to hold, and is low cost, and is low churn, so on and so forth. So you can only optimize it along one or two dimensions, and how you set it up is, it's a close sort of relationship with the client, walking him through or her through different scenarios, how the portfolio might play out, and what the investor is comfortable with. Most investors are comfortable with a portfolio that prevents a steep uh, 20% drop that you saw in the markets, even if that includes paying a sort of performance penalty across the lifetime of the investment. Because what happens, at least what I've seen, is that every 3 years, Indian equities tank 20-30%, right? So every 3 years there is like a steep drawdown. It's usually nothing to do with us. It's all imported crisis, either the global financial crisis or our own political sort of setup, but most of it is imported, and we can't do much about it. So what you need to have some sort of risk management policy set up upfront, so that you're sort of protected from those kind of things. So if your portfolio skips those events, right, over a 5-year period, it'll come up ahead because of geometric compounding, right?
Yeah.
Geometric compounding, understanding it is probably the most crucial thing for most investors. If your portfolio drops 50%, it requires 100% gain from that point to go back to where it was before, right? So that's how geometric compounding hits you. So you're better off avoiding that 50% loss, curtailing it as much as possible, than to say that no, 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 I'll just wait it out and see what happens. Waiting it out, most US centric investors recommend, because that's how US markets have behaved, right?
Yeah.
They've all recovered from 1987, from the 2000 crash to 2008. They've all recovered, and they've gone far ahead. But that has not been the case for Indian investors. We fall and we stumble and we keep stumbling and we keep tumbling. So either the rupee falls, or our markets don't rise up fast enough and far and go far ahead. So there's something or the other that goes wrong for Indian investors. You're better off, from an Indian point of view, you're better off trying to avoid those steep drawdowns.
Yeah.
That's been my recommendation and advice as well.
Okay, I think I mean, what the book also talks about is a lot about this pessimism, right? So when the market falls and stuff, especially a steep fall, people think it's like the end of the world.
Yeah.
Like especially I think this year when the market fell, so sharply in March, a lot of people, it's like a true black swan in the sense that, I mean, a pandemic is not a black swan in the sense that it's like an earthquake or like a volcano, but in the sense that you had lockdown and stuff that the entire world, that's something that no one saw, and when you saw that people extrapolate and stuff, oh my god, this is the end, or but the world usually does not end, I think that kind of pessimism is, I think, what is fun to read, and it's fun to take part in it, but it's very bad for your I mean for investment, because suddenly you would lose, if you had exited, when the market fell, or stopped investing when the market fell, you would be in a much worse position right now. I mean, not that uh, no one knows what's in the future, but the point is that it's to stay the course, and not get it's not to dwell into, I mean, like, pessimism too much.
Right. Look, this is going back to fat tails and my basic problem with behavioral finance, right? First of all, behavioral finance, works in the sales domain. You can use it to pull different levers to make a sale and so on and so forth. But I think applied to an individual's experience, it's a recipe for disaster when it comes to investing. And I don't think investors who pulled money out of the market were behaving irrationally, and that we should lecture them on staying the course. Because first of all, when the market starts falling, you don't know where it's going to end, whether it's going to be a 5% correction or a 10% correction or 50
Oh,
or
it will. Yeah.
we don't know that. And because of geometric compounding, if you pulled all your money out at 10% and re-entered after the market bounced, even after it bounced back 10%, something like a trend following system, you came out far ahead from someone who just bought and hold and prayed during during the fall. I'm not a big fan of let's just hope things will bounce back, and I'm for the long run, so on and so forth, because I think that's a very US centric approach.
Yeah.
They did send out $1,200 to everyone,
Yeah.
right? And here we are sending $1,200 to the government, right? so
But
it's and those guys, it's a different mindset. Those guys, and it's worked out for them. So
yeah.
good for US citizens. But in India, you're supposed to take care of yourself and your own finances. There's no, social security. There's nothing here. So you need to worry about a lot of, lot of
Things.
different things.
Yeah.
So
Yeah, so
it's
yeah, I mean, the thing is not to blame. I mean, it's not to blame someone, say someone who needs money and withdraws because he's afraid that it might be half of what he needs. Say somebody who wants. I'm not. It's not blaming them, but it's like uh, especially in our world, when the market falls, you hear a lot of like pessimism, right?
right.
Like
Yeah,
the
some guys wanted to shut down the markets and so on and so
yeah, yeah,
forth.
that on the market. And I mean, and basically, just basically, predicting the end of the world. Like stocks will be worth nothing. The only scam companies in India, apart from three, four companies, there's nowhere can invest. I mean, that gets a lot of traction. I I still remember, in when when demonetization happened, everyone was like, the I mean the economy will stall, no cars will get sold and stuff. And I went and met a dealer, uh, for this, and he said nothing. I mean, the car sales will do really well because I mean, all the banks and financial companies are pushing, before before they would lend at like on, I mean, the ex showroom. Now they're lending like on a road price, and they're lending at at a low interest rate, and there's so much demand for cars that I mean, it's been great. And when I went and told some people in the financial world this, they couldn't believe. They were like, no, I spoke to this journalist and stuff like that, and um, that end of that pessimism is perhaps analytic. That's not if if someone withdraws because they feel unsafe, and they feel it might not be the right thing for them at that point in time. That's different than somebody believing that the end, you know the end will happen.
Right.
Yeah.
Yeah, I agree. So what else was there in the book? Any headlines that you want to wrap this up with?
Well, I think I think most people should read the book, even if you're whether you're in finance or not finance. I in fact bought like 10 copies to give it to my friends because
Okay.
they have no. I mean, most of them have no uh, idea about. They have no idea about investing finance, and this is an easy read. I mean, it's like it's like it's a simple book which most people would understand and get. It doesn't talk about investment strategies, how to make money, and that sort of stuff. It's just about how. I think the most important part for me is that like behavior matters a lot more than things that you would imagine, like say in like multi-bagger stock or in infrastructure. I think like investing behavior is so much more important than uh, the thing that me and you normally we spend the days doing. I think and that is why I think both of us are so. I think that like we like in our strategies we like have like automated them or like at least made it systematic because we want to avoid these emotional biases. Uh, um, and I think this book just emphasizes that.
Right. Cool. So I'm gonna, you're gonna make me read that book, aren't you?
Yes.
So with that, we will wrap this episode of Free Float. Do read the blog and the information about the book and links to that on Amazon is on our Substack. We'll catch you again next weekend, and until then, stay safe. See you later.
Right.